Money World All. Introducing your ultimate destination for all things money related. Welcome to Money World All channel. Your time is gold. Watch at 1.5 speed. Let's start.
When it comes to investing, understanding investment fees is crucial for making informed decisions. Investment fees can have a significant impact on your overall returns, and should be carefully considered before committing your hard-earned money. In this article, we will delve into the various types of investment fees, their importance, and how you can assess and compare them effectively. The significance of investment fees. Investment fees encompass the costs associated with managing and administering an investment portfolio. These fees are typically charged by financial institutions, such as brokerage firms, mutual fund companies, and investment advisors. While fees may seem insignificant at first glance, they can significantly erode your investment returns over time. One of the primary reasons investment fees are important is their direct impact on your net returns. When you invest, you expect your money to grow over time. However, investment fees act as a headwind, reducing the overall growth potential of your portfolio. Even seemingly small differences in fees can have a substantial impact on your wealth accumulation over the long term. Types of investment fees. To better understand investment fees, let's explore some of the common types you may encounter. 1. Management fees. Management fees are charged by mutual funds, exchange-traded funds, ETFs, and other managed investment vehicles. These fees cover the cost of managing and operating the fund, including research, trading, and administrative expenses. Management fees are typically calculated as a percentage of your investment and are charged annually. 2. Expense ratios. Expense ratios are another type of fee associated with mutual funds and ETFs. The expense ratio represents the percentage of the fund's assets that are used to cover its operating expenses. This includes administrative costs, management fees, and other operational expenses. Like management fees, expense ratios are deducted annually from the fund's assets. 3. Sales loads. Sales loads are fees charged when you buy or sell certain types of mutual funds, often referred to as load funds. There are two types of sales loads: front-end loads and back-end loads. Front-end loads are paid when you purchase a fund, typically as a percentage of your investment. Back-end loads, also known as redemption fees, are charged when you sell your investment. These fees are intended to compensate brokers or financial advisors. 4. Advisory fees. If you work with a financial advisor or investment manager, they may charge advisory fees for their services. Advisory fees can be calculated as a percentage of your investment assets, or based on a fixed fee structure. These fees cover the advice, guidance, and portfolio management provided by the advisor. 5. Custodial fees. Custodial fees are charged by custodians or brokerage firms for holding and safeguarding your investment assets. These fees can be based on a percentage of your assets under management, or a flat fee. Custodial fees are particularly relevant if you hold self-directed brokerage accounts or alternative investments, like individual stocks or real estate. Assessing and comparing investment fees. Now that we have a clear understanding of the various types of investment fees, Let's explore how you can assess and compare them effectively. 1. Read the prospectus. The prospectus is a document provided by investment funds that outlines important information, including the fees and expenses associated with the investment. Make sure to carefully read the prospectus before investing to gain a comprehensive understanding of the fees you will be charged. 2. Compare expense ratios. Expense ratios are an essential factor to consider when comparing mutual funds or ETFs. Lower expense ratios generally indicate that a larger portion of your investment will be working towards generating returns rather than covering expenses. However, it's important to consider the fund's performance and other factors alongside the expense ratio. 3. Understand the fee structure. Different investment vehicles have varying fee structures. Some funds may have a combination of management fees and performance-based fees, while others may have fixed advisory fees. Ensure you understand how the fees are calculated and how they may impact your returns. 4. Consider tax efficiency in addition to investment fees. Consider the tax implications of your investment choices. Some investment strategies may generate higher tax costs, which can further impact your net returns. Look for tax-efficient investment options to optimize your after-tax returns. 5. Seek transparency when choosing a financial advisor or investment manager. Look for transparency regarding their fee structure. Ensure you understand the services they provide and the associated costs. Compare multiple advisors or firms to find the one that offers value for their fees. 6. Evaluate performance net of fees when assessing investment performance. Always consider the returns net of fees. This will give you a more accurate picture of how your investments are performing. Avoid solely focusing on pre-fee returns, as they may not reflect the actual gains you can expect. Conclusion: understanding investment fees is crucial for making informed investment decisions. By carefully assessing and comparing fees, you can optimize your investment returns over the long term. Remember to consider different types of fees, such as management fees, expense ratios, sales loads, advisory fees, and custodial fees. Read the prospectus, compare expense ratios, and seek transparency when working with financial advisors. By paying close attention to investment fees, you can protect your wealth and ensure you're on the path to financial success.
Thank you for watching. Don't forget to like, subscribe, and turn on notifications.